Good morning, everyone. Welcome to this update for global markets for the 3rd of August. And we saw a considerable amount of nervousness towards the end of last week. It's pretty normal for this time of year. And as we'll see, it's going to present a very good opportunity, I believe. This is the time of year when markets are going to be a bit sideways to down, and they'll present some good opportunities. It's actually very hard to get good entries when everything is really bubbling along as it has been all year. So this is the time when you can really position yourself quite well. So let's go on and have a look at exactly what happened last week and where the opportunities are. So the S&P index ended up down 53 points on the week, and it all basically occurred in the final 2 days. There was a series of triggers. I'm not sure that any of them in their own right actually had a great deal of substance. There was some fears about a default in Argentina. There were fears about Russia. There were fears about the Middle East. There were all sorts of things. But it was really just a matter of markets needed an excuse to sell off, and these triggers were the ones that did it. American reporting season is still progressing extremely well. There are lots of companies, particularly in the high growth sectors that I follow, that are still beating expectations quite comfortably, and some of the stocks are actually smashing expectations by a long, long way, and also presenting very robust outlooks. So despite the fact that markets are pulling back, if you look at the fundamentals underlying it, they're just terrific. So I'm as enthused and excited as ever. In fact, probably more so, because now we're going to be able to get some better entry prices than we've been able to do over the past 6 months or so. So continue buying the dips in the high growth sectors. Now it's also high growth sectors where you can buy the stocks cheaply, because there certainly are some stocks in high growth sectors that are just stupidly overvalued. So you still need to know what you're doing, but if you've got your focus on the right sort of stocks, as I have, then buying the dips is going to be a very profitable and very high probability exercise. I'm looking for 1900 to around 1920 support area on the S&P. It's possible it might go down a bit further, but that's the likely support area that I'm looking at this stage. So you can see that the S&P, the index, despite the sharp sell-off, is still well above the moving average. May pull back a little bit more, and if it did, that would correspond pretty much to the relative to the lows. The last couple of lows you can see here, one in February, and again another one in April. It would also correspond with these old peaks here in April and in May. And would be back pretty close to the 150-day moving average, and also would be a 38.2% retracement of the last run up in the market. We'd also have the index down to oversold, and with the fundamentals through American reporting season as good as they are, it's hard to see the index going down too much further from there. Given that it's a softer time of the year, it's midsummer holidays in America, volumes are thinner, and there's generally not a lot of triggers to actually propel stocks upwards. I think it's quite likely that we may see a decline into this area that I've nominated. So we're looking around about this area through here. And it may well be that it'll just muck around in that area for a period of a few weeks, maybe a little bit of a rebound and then a retest down, and basically set itself up for the traditional strong run into the end of the year. Now, moving on to the Australian market, the ASX index only ended up down 27 points on the week, but I suspect that it will fall further on Monday in response to what happened on Friday night overseas. It made a false breakout to a 6-year high. It looked pretty strong. The banks were going well. BHP and Rio were also going along quite well, and then a very sharp reversal on Friday in response to what happened overseas. So I would expect that across the board selling that we saw on Friday will probably continue, and that's why I'm now saying that the index has probably experienced a false break out of the range. It looked promising for a couple of days, but really with our major stocks pretty fully valued, I was always a bit doubtful about how far it would go. So I think we can expect maybe 4 to 8 weeks of weaker to sideways action in the Australian market. So let's just take a quick look at the Aussie index. So you can see bubbling along quite nicely. We actually got a breakout on Wednesday and Thursday. That was the all-time highs up there, the 6-year highs. So we got a little bit of a breakout out of this range, but it didn't last very long. The breakout really started on the 23rd of July. Only lasted about 6 trading days, and then a very, very sharp rebound down on Friday. So expect to see more downside in the Australian market. We might see another 100 or 200 points come out of the index over the next few weeks. Moving on to commodities, gold was down $14 for the week, but it was mainly about US dollar strength more than anything else. And encouragingly, gold stocks and silver stocks held their ground. Overseas, I'm talking about. So that's the encouraging thing, that precious metal stocks are still holding up pretty well. Silver remains stable. There was the sort of moves where silver can get a bit more volatile, but managed to hold stable. Copper eased to $3.20, but really not much movement there, and that's a really positive level and is still a good sign for the global economy. Crude oil slipped back down under $100, down to 98. There's the spot copper chart. You can see it's been pretty steady now for the best part of a month, and similarly with nickel, which is up 50% this year, has also been holding its ground as well. Let's just have a look at the gold charts. First of all, on a weekly, so you can see not a lot of change in the gold price, bit of a dip and then a recovery. If we look at that on a daily chart, you can see the main dip really occurred on Thursday, and then we had another little dip but a recovery on Friday. So precious metals still performing quite well. There's silver, not much change there on the week. Now turning to the major indices, this is the GDX index. I'm not quite sure what this big spike up here is about. I can't believe that's valid. It might be a bit of a piece of rogue data in there, because I don't think gold stocks really moved that far, certainly not to the upside. But still in a big phase 1 base for the GDX index, but it is solid. And I think it's just a matter of time before we see a breakout. And similarly, that's the GDX index as well, actually rose quite nicely on Friday night. So the precious metal space all going along quite well. So just looking at it from an overall strategy point of view, as I said at the start, it's difficult to get yourself positioned well when markets are really buoyant. I know that it's easier because everyone's positive and prices are going up, but you actually don't get very good entry prices under those sort of conditions. The next couple of months, I believe, will throw up some terrific entry prices if you're patient and disciplined about what you're looking for. So expect a month or two of softer markets. It's normal. Normally happens this time of year. August, September are normally the weaker times of the year. So there's nothing untoward going on here. And as I said, the American reporting season is just coming through so well that it's really hard to see too much more downside in the market. In terms of trading and investing at the moment, it's certainly a time for caution because people do panic a bit. And with volumes thinner in America and in Australia, prices can move around quite disturbingly. It's all a lot of just noise that you need to ignore, but they can move around quite a bit on low volume. So it is a time for caution, but it's also a time to be thinking clearly and positioning yourself for the opportunities to come. There is still money to be made. You just need to be a lot more judicious about how you go about it. For anyone that would like some more information who's not a member of Specialist Share Education, there is information on our website. And of course, there's my email address. Always happy to communicate with other traders and investors. That's it for this week. Cheers.